Welcome to the debate. Today, we aren't just looking at a red candle on a chart. We're essentially dissecting a financial crime scene. Bitcoin has violently retraced, piercing that $65,000 level and taking nearly $500 million in leverage positions down with it. Specifically, we saw about $434 million in long positions vaporized in a single sweep. It's a bloodbath out there, and the market sentiment has flipped from greed to extreme fear in the blink of an eye.
It really is brutal. And the central question we are wrestling with today is whether this is a mechanical flush, a buy the dip gift wrapped in panic, or if the macroeconomic tectonic plates have fundamentally shifted. We have stagflation signals flashing red, we have a Federal Reserve that is suddenly handcuffed, and we have geopolitical escalation with Iran alongside aggressive, unpredictable tariff wars. I'm arguing that this isn't just a dip. It's a regime change toward a prolonged bear market structure.
And I'll be taking the other side. I argue this was a necessary mechanical purge of over-leveraged speculators, a liquidity hunt that resets the board for higher prices. When you look at the raw data of institutional accumulation from players like MicroStrategy and the potential regulatory unlocks for stablecoins, the structural bull case is bruised, sure, but it is very much intact.
I think that's wishful thinking in a pretty toxic environment. But let's get into it. You're the bull today, so tell me why a breakdown to $65,000 isn't just the start of a rundown to $50,000.
Well, because the market is an efficiency engine, and right now it's punishing greed, not value. My position is that the drop to $65,000 was a textbook liquidity hunt.
Define that for those who don't stare at order book heat maps all day.
Sure. Markets tend to move toward areas where there are a lot of stop-loss orders, because, that's where the liquidity is. We had a daily high around $68,400. The market pushed up, failed to break out, and then aggressively reversed to flush out the people who were long at the bottom. That $434 million wipeout isn't a fundamental failure. That is the market taking the money of impatient traders who were over-leveraged. For a long-term investor, buying these dips near yearly lows is statistically far more profitable than chasing breakouts. The hash rate, the computing power securing the network, is at record highs. Structurally, the house is strong. We just blew out some windows during a storm.
Right, but the problem is you're looking at the house, the whole neighborhood is burning down. You cannot separate the technical chart from the macro world. My position is that the buy the dip reflex is broken because the liquidity spigot has been completely turned off. We are seeing a bearish breaker block forming on the NASDAQ right now.
Let's pause there. Explain bearish breaker block quickly so everyone is on the same page.
It's a technical pattern. Essentially, it's a support level that held the price up previously, like a floor. But once price smashes through that floor with high volume, the psychology flips. That floor becomes a ceiling. It becomes resistance. Because everyone who bought at that level is now trapped underwater, and they're just waiting to sell to break even. If the NASDAQ respects this bearish structure and rolls over, Bitcoin, which is highly correlated to risk assets right now, is going down with it. But the real nightmare isn't the chart, it's the Federal Reserve.
You referring to the drastic repricing of rate cuts we saw this week?
Repricing is putting it mildly. The probability of rate cuts has utterly collapsed. The market is now pricing in a near 48% chance of zero rate cuts, even looking as far out as June 2026. Why? Because of the data we got on Friday. We are walking into a stagflationary trap. When you combine that with the current trade wars, capital isn't looking for value entries in crypto. It's looking for a bunker.
Okay, let's dig into that first, because that's the heavy hitter. Topic 1, the macroeconomic vice. You brought up the Friday data. Let's break it down.
The data was unequivocal. The GDP growth numbers were poor, meaning the economy is slowing down, output is sluggish, but the core PCE, the inflation metric the Fed watches most closely, remains sticky and high. That is the textbook definition of stagflation. Stagnant growth, inflationary prices. It is the worst possible economic quadrant to be in.
It's certainly the hardest to navigate.
I'd argue it's impossible to navigate. This data literally blocks the Fed. Before this print, the market was optimistic about March or April cuts. Now, March is dead. April is dead. Confidence in June is evaporating. Here is the mechanism for the listener. If the Fed cuts rates to help the slowing GDP, they spike inflation even higher. If they raise rates to kill inflation, they crush the GDP into a full-blown recession. They are stuck. When the central bank is stuck, they do nothing. And when they do nothing, liquidity dries up. Bitcoin needs liquidity like a fire needs oxygen.
I agree that print was ugly. However, I disagree that it's a fatal blow. Markets are forward-looking mechanisms. They react to the shock of the data, not necessarily the long-term trend. Look at the Nasdaq's reaction on Friday.
It opened red. Deep red. It opened red, yes. But then watch the tape. It showed resilience. It swallowed a significant chunk of that drop and consolidated above 24,900. If the market truly believed the stagflation doom narrative you're painting, we would have seen a circuit breaker style collapse where trading is halted entirely. We didn't. We saw absorption. That tells me the market had already front-run some of this fear. The big players were expecting this.
Absorption for now. But you can't fight the trend. The easy money narrative, the idea that the Fed is about to turn the money printer back on, was fueling the crypto rally earlier this year. That narrative is gone. The market is starting to worry that cuts might not come until July or even later. That is a massive repricing of risk assets. You can't justify a 60 PE ratio on tech stocks or a $70,000 Bitcoin if money remains expensive for 2 more years.
But we have upcoming data that could flip the narrative just as quickly as it flipped last week. We have the PPI, the Producer Price Index, coming up this Friday.
Which measures inflation at the wholesale level.
Right. It's a leading indicator for consumer prices. If the PPI shows cooling, the stagflation fears could vanish overnight. The market hates uncertainty more than it hates bad news. Plus, we are waiting on upcoming political speeches. Once there is clarity on the tariff situation, the uncertainty premium evaporates.
I think you are far too optimistic there. And that brings us directly to the second major issue, which is geopolitics. This isn't just standard political theater where politicians yell at each other. We're seeing a genuine rupture in global trade norms.
You mean the tariffs?
I mean, the defiance of the rule of law regarding trade. We've seen an increase in tariffs to 10 to 15% for all countries. But more importantly, there's explicit defiance of a Supreme Court ruling. The court declared previous punitive tariffs illegal and ordered a $175 billion repayment to affected entities. The response was a flat refusal to pay, followed by raising taxes again. This destroys the predictability of global commerce. If you're a global investor, how do you allocate capital when the rules change on a whim?
It is aggressive, certainly, but I view it as a high-stakes negotiation tactic. It breaks the system to rebuild it on better terms for the U.S.
It's more than negotiation when you combine it with Iran. We have to talk about the war risk. There are active threats of removing the Ayatollah by force. We have U.S. naval fleets positioning themselves right now.
But let's look at the actual numbers, because headlines are designed to scare you into selling.
The numbers are concerning regardless of how you spin them.
But they are significantly lower than previous conflicts. We're looking at about 500 aircraft near Iran now. Compare that to the Gulf War or the Iraq invasion, where we had 1,800 to 2,700 aircraft. We are at a fraction of the force required for a full-scale invasion. This is posturing. It's saber-rattling to force a diplomatic outcome, not a prelude to World War III.
You don't need an invasion to crash the market. You just need to threaten the Strait of Hormuz. Even with 500 aircraft, the pressure is sufficient to make Iran nervous enough to mine the strait or attack tankers. That chokes off oil transit. If oil spikes, inflation spikes. If inflation spikes, the Fed hikes rates again. It feeds directly back into that stagflation loop we just discussed. It's a domino effect.
I see why you think that, but let me give you a different perspective on how the market is actually trading this, not how it should trade it. Look at gold and the Nasdaq. They are moving in tandem.
Which is highly unusual. Usually, they are inverse.
Exactly. One goes up, the other goes down. You might interpret that correlation as total system failure, but I see sophisticated hedging. Investors are closing Nasdaq positions to open gold positions. They are managing risk within their portfolio, not fleeing the system entirely. And regarding Iran, despite the fear, uncertainty, and doubt, there are deals being negotiated behind the scenes right now.
What kind of deals?
There is chatter in intelligence circles about U.S. companies potentially entering Iranian energy sectors in exchange for limits on civil uranium enrichment.
Wait, you think Iran offering to let U.S. companies into their energy sector under military threat is a bullish signal? It sounds like desperation. It sounds like a regime trying to buy insurance.
I think it shows that a path to de-escalation exists, and money is doing the talking. The market prices in maximum fear prematurely. We've seen this time and time again. The initial headline regarding the Strait of Hormuz causes a crash, and then the reality of diplomatic back-channel stabilizes the price. If you panic sell on the headline of war, historically, you usually lose money.
Or you preserve capital. I'd rather miss 5% of upside than catch 30% of downside. The risk-reward ratio just isn't there with this geopolitical backdrop.
Let's pivot to the asset itself, because despite this macro storm, the crypto-specific signals tell a totally different story. I want to talk about market structure and institutions. While retail investors are panic selling because of a scary headline, what is smart money doing?
You're going to mention MicroStrategy.
I absolutely am. Michael Saylor just executed their 100th Bitcoin purchase. They now hold 717,000 BTC.
Which creates a massive concentration risk, by the way. If MicroStrategy ever has to liquidate or if Saylor steps down, the market goes to zero. It's a central point of failure.
But they aren't liquidating. They are accumulating while the market bleeds. That is a vote of confidence from the largest corporate holder in the world. They are playing a multi-decade game while you are worrying about next week's PPI print. Furthermore, look at the regulatory landscape. The SEC has a proposal on the table to classify stablecoins as liquidity for U.S. banks.
Explain why that matters to the price of Bitcoin.
Currently, banks have strict requirements on what assets they can hold to meet liquidity needs, usually treasuries or cash. If the SEC allows stablecoins to count as cash equivalents for bank liquidity, it unlocks massive systemic demand for crypto dollars. It integrates crypto into the plumbing of the U.S. banking system. It essentially legitimizes the rails of our industry. The market is completely ignoring this potential unlock because it's hyper-focused on the Iran headlines.
That's a proposal. It's bureaucratic paper pushing that might take years to implement. I'm looking at what is happening on-chain right now. You talk about smart money buying, I see smart money selling. Vitalik Buterin and the Ethereum Foundation have sold approximately $6 million worth of ETH recently.
That's a drop in the bucket. Executives sell to cover operational costs. It's standard.
It fuels negative sentiment at the worst possible time. When the co-founder is dumping millions while the price is crashing, it signals that they don't think the bottom is in. And technically, Ethereum looks horrific relative to Bitcoin.
It's certainly weaker, I'll grant you that.
It has already smashed through its support zone. If the macro pressure continues, there is a void of support. I'm looking at targets of $1,736 or even $1,380 for ETH. And for Bitcoin, if this support at $65,000 fails, and we've already wicked below it, where's the next floor? There's nothing meaningful until $61,900, or the untriggered quarterly low of $58,900.
I'm not convinced by that line of reasoning because you're assuming the support has failed. Technically, we are still ranging. Unless Bitcoin definitively closes the week below roughly $67,800, the bull structure is simply resting. We are testing the resolve of the market. The $65,000 level was the weekly low we needed to tag to grab that liquidity we talked about earlier. We tagged it. Now we watch for the reaction.
But the reaction has been weak, though. We didn't bounce with vigor. We are lingering, and lingering at support is usually a precursor to breaking through it. You mentioned the hash rate is strong. Sure, the network is secure. But the price is determined by liquidity, and liquidity is being drained by the Fed and fear.
But let's look at the liquidation data again. $434 million in longs wiped out. That leverage is gone. The market is lighter. It requires less capital to push the price up now than it did 3 days ago. When the leverage is flushed, the spot buyers, the real investors take control. And as I mentioned, we are in a zone where buying yields better statistical returns than buying the breakout.
That assumes the bottom is in. My concern is the bearish breaker on the NASDAQ. If that index rolls over because of the NVIDIA earnings coming out this Wednesday, which are highly anticipated and high risk, Bitcoin will not decouple. You cannot have a crypto bull market in a global equity bear market. It hasn't happened yet.
It's true that correlation is high right now, but NVIDIA could also surprise to the upside. And if there's any clarity on the tariff exemptions, the Nasdaq recovers. You're betting on a perfect storm of bad news. I'm betting on the resilience of an asset class that has survived worse.
I'm not betting on a storm. I'm looking out the window and seeing rain. The probability of the Fed not cutting rates is rising. That is the single most important metric for risk assets. If money isn't cheap, crypto struggles. It's don't fight the Fed 101.
And I would say don't fight the trend of adoption. The SEC proposal, the institutional accumulation, these are slow-moving but unstoppable forces. The Fed's delay is a speed bump, not a roadblock.
A speed bump at 60 miles per hour can destroy your suspension.
Or it just wakes you up. Look, we are approaching the end of our time, and we need to synthesize this for our listeners.
Agreed. There's a lot to process here.
So, to summarize my perspective, I believe the crash to $65,000 was primarily a leverage flush. We wiped out nearly $500 million in speculation, which is healthy. The long-term thesis, driven by the halving cycles and spot accumulation from entities like MicroStrategy, remains valid. I urge listeners to view the $64,000 to $65,000 zone as a discount. Technically, as long as we don't close the week disastrously low, we are just consolidating. The fear regarding Iran and the Fed is real, but likely priced in at maximum impact already.
And my summary is this: the old adage, don't fight the Fed, applies here more than ever. With stagflationary data, stagnant growth, and rising prices, the Fed is handcuffed. They cannot cut rates as expected. Combine that with erratic tariff policies and the genuine risk of conflict with Iran, and the macro backdrop is toxic. The path of least resistance is lower. I believe we will likely test sub-$60,000 levels, possibly $58,900. Buying here is catching a falling knife until we have clarity on the Nasdaq's direction.
We can both agree that this upcoming week is absolutely critical.
Without a doubt, we are watching three things: the weekly candle close, the NVIDIA earnings report on Wednesday, and the upcoming political statements to see if the Nasdaq stabilizes.
Exactly. If the Nasdaq stabilizes after NVIDIA, Bitcoin likely holds. If the tariffs are clarified, the fear subsides. Investors really have to choose right now between a strategy of technical accumulation, buying these supports, or macro preservation, which means sitting on your hands until the geopolitical smoke clears.
And remember, watch that $67,800 level. If we can't reclaim that, the bears are in control.
And watch the PPI data. If inflation cools, the bulls might just come charging back.
We'll see. The market has a way of humbling everyone.
That it does. That's all the time we have for today. Thank you for listening to the debate. Analyze the charts, read the news, and make your own decisions.
Stay safe out there.